loved ones. And this is going to be delivered by a team of Ledyard folks. We have an incredible depth of talent at our organization, and you're going to hear from a few of those folks today. Before we begin the panel discussion, though, as you know, is tradition at this breakfast, we do have an opportunity for one of our guests to tell a story about what they do, either talk about their product, their service. And since Ledyard is the presenter today, we thought our story today would be from one of our Ledyard folks. So I'd like to ask Deanna to come up and tell us what you do every day.
Great, thank you, Jackie.
So is this working?
Yes.
So thank you, Kathy. As Kathy said, I'm Deanna Wilson. I'm a senior financial advisor with Ledyard's Wealth Management Group, Ledyard Financial Advisors. We grew out of Ledyard's Investment and Trust Department, and while we still do offer trust and investment services, we're now able to offer comprehensive wealth management services. This does include investments, but it really is so much more. We discuss with our clients their financial goals and objectives, and then we review their investments, their retirement plans, insurance policies, and planning documents to make sure that all are in place and work well in coordination with each other. Many of our clients are retired and have spent their lives accumulating assets. I work with them now to develop plans to preserve their wealth and to provide for their ongoing cash flow needs in retirement, and then eventually to pass assets to family and charities. While working with my clients, I view myself as an issue raiser. I want to make sure our clients have considered all aspects of their financial lives. One recent case comes to mind which illustrates how we work with our clients. A retired couple came to Ledyard in 2009. They're a pretty typical financial advisor clients. They're in their late 70s. They owned a family business, and as we often see in that generation, the husband handled all of the finances and investments. After he'd been with us for a while, he told me that he came to us so that if something happened to him, his wife would be able to continue to live as usual without financial concern. Initially, we helped them with investments, and then in the 4 years we've worked with them, we've explored many areas of wealth management. We completed a review of their estate planning documents. They moved here from New York about 8 years ago, and while reviewing those documents, we discovered they'd never updated those plans. They still had old New York documents that didn't take advantage of any of the current New Hampshire trust tax rules. So I talked with them about their plans and introduced them to a New Hampshire attorney. So now they do have current plans in place. And once those were up to date, we helped them retitle all of their accounts to the names of their trust to provide continuity of management. Then we reviewed their IRAs and insurance forms to make sure that all were current. While reviewing their insurances, we found a gap and encouraged that they buy umbrella insurance so that they would be protected in case they were ever sued. As many individuals do, they did have their financial accounts at many financial institutions. We worked with them to consolidate assets, to keep it simple for them, and to provide comprehensive management. Sadly, the husband now lives in an assisted living facility. We've arranged to pay their bills, established a plan to fund their cash flow needs. We help them with some gifting so that they retain sufficient assets to cover their expenses, even if the long-term care expenses increase. We've met 3 of their children who are thrilled with the way we have worked with their parents, and one of the sons lives locally, and he's asked me to help him with his own planning. But importantly, we've helped fulfill the husband's goal. His wife continues to live as usual without financial worry. And this is just one example of how we at clients. We raise financial issues and help them with all aspects of their financial lives. In short, we really help them plan well so that they can live well.
Thank you, Deanna. Thank you very much, Deanna. Oftentimes people ask us, what do you do at Ledyard Financial Advisors? Do you just invest money? And investing money is, yes, a part of what we do, but there is so much more. So we just thought it would be helpful today to share with you what we do beyond just investing money. I'd now like to introduce Valerie Neville. Valerie has many years' experience in the wealth management business, and I'll let her tell you about herself. Valerie's going to lead our panel today, and she will introduce the rest of the folks on the panel.
Thank you, Kathy. I'm just going to switch mics because I can't click and hold on to this at the same time. Can everybody hear me? Oh. Did somebody walk off with my notes? Great. Was that me? It was me. Sorry, I did that to Sarah yesterday. I walked off with things on her desk. I might have been able to wing it, but you're going to have a better experience with my notes. So today we're going to talk about strategies for protecting your loved ones. We'll be discussing ways to protect yourself financially. The best gift you can give your kids and your family is to be able to take care of yourself. We're also going to be talking about ways your family members, and you can encourage them to protect themselves. On your table is a notepad. We're going to be having questions at the end, so please feel free to jot anything down as you get started. So, as Kathy said, I'm a senior financial advisor at Ledyard, where I've been for 15 years. I have about 25 years of experience in the financial services industry. I'm a New Hampshire attorney and have an MBA. And I've been with Ledyard for 15 years, and I just love working at Ledyard. So my co-panelist is Deanna Wilson. Deanna is a senior financial advisor at Ledyard as well. She holds a BA in Business Management and International Studies from Norwich University. She's been in the wealth management business for 22 years. She's a certified trust and financial advisor and a certified financial planner. And Deanna lives in Grantham and has 3 children. And also here today to talk is Rob Gallo. Rob is a private banker with Ledyard Financial Advisors. So he's a liaison between the investment clients and all their personal banking and credit needs. He's been in the banking and financial services industry for 26 years. He's a graduate of Connecticut State University, and Rob lives in Bradford, Vermont. So today I'll be discussing ways you can use trusts and other estate planning vehicles to protect your loved ones. Deanna will be covering retirement planning and how insurance can be used to protect your family members. And Rob will talk about the credit and the proper ways you can protect yourself from fraud. I know of a case where there was a business owner who had a business in Massachusetts. It was a very successful business, and his 2 daughters were involved in the business. He had 3 daughters in total. And his financial advisor encouraged him to take care of his estate planning. He was very busy with his business, and he felt that it really wasn't necessary. His children got along beautifully. They knew how to manage the business. He didn't think there would be any problems after his death. Well, after he passed, one of the daughters went through a divorce, and her ex-husband ended up with half of her interest in the business. Another daughter ended up going through bankruptcy. Within 2.5 years, the business was bankrupt. And if he had done some proper estate planning, I think the business would have survived. So these issues I'm going to talk about are really, really important. In specific today, I'm going to be talking about a financial power of attorney, a healthcare power of attorney, and trust and to protect your family members. So a financial power of attorney. A financial power of attorney is a document whereby you give an agent authority to handle any of your financial transactions while you're unable to handle them. The document is only valid while you're living. Many people assume that it can continue when you're gone, and it can't. It's very useful. I know of a case where a woman was in the hospital for 3 months, and during that time, her bills would have been unpaid, but she did have a durable power of attorney, and the agent was able to take care of her bills during that time period. So it's an important document for people to have, and also if you have adult children, that they have it so you might be able to handle their affairs if something should happen to them, so that they maybe were a study abroad program or something, unable to handle their bills. The next document is a healthcare power of attorney. And the healthcare power of attorney is a legal document whereby you appoint an agent to handle your healthcare decisions in the event that you're unable to. And in addition, today, healthcare powers are even more important than they were years ago. And the big reason is the Privacy Act. With the Privacy Act, people can't get access to medical information on their family members unless there's a health care power of attorney. I had a friend whose child ended up having a nervous breakdown in college, and that friend not only wasn't able to get any medical information about her son, she wasn't even able to get information in order to pay the bill. So please make sure you have one of these and your family members do as well. For trusts, I'm going to be talking about special needs trusts, spendthrift trusts, self-settled trusts, trusts for minors, and 529 plans. What do you do if you have a disabled child? How do you get them money without disqualifying them for benefits? The answer is a special needs trust. In a special needs trust, the parents or other members provide money to set up a trust either during the beneficiary's lifetime or at their death for the disabled son or daughter. There's an independent trustee. If it's set up during the life, they can contribute it. At death, it's often funded through life insurance. And anybody can give money to the special needs trust, friends, family, and the key to the special needs trust is that the money cannot be used for basic necessities if the party is receiving benefits. So under social, if they're, for example, receiving Social Security, those Social Security payments are used for their basic necessities, and if they are given additional money for basic necessities, it ends up reducing their benefits or even eliminating them. So I have a friend who has a daughter who's has special needs, and she's set up one of these trusts, and it's currently being used to help her daughter do the little extras that she wouldn't be able to do otherwise. And there's also a life insurance policy so that my friend knows on her death, her daughter is going to be well cared for financially. What do you do if you have a child that spends every penny they make and every penny you give them? How do you protect them if you can envision that someday they might go through bankruptcy? The answer is a spendthrift trust. Spendthrift Trust is a trust created for somebody that is often unable to control their spending, that gives the independent trustee full authority to make distributions either to or for the benefit of the beneficiary. Creditors of the beneficiary cannot get those assets. The key is the independent trustee has the discretion to make distributions, so those distributions cannot be compelled. And the key to this is keeping it out of the beneficiary's hands. Once the money goes out into the beneficiary's hands, creditors have the right to attach that. So one way to get around it is for the independent trustee to pay the bills they feel necessary on their own. And the Spendthrift Trust has to be irrevocable. Many revocable trusts that people set up for themselves have a spendthrift provision in them. So you may not realize if you have a revocable trust, but it probably has one in there so that if the trust continues at some point, the creditors can attach it. I have a client who set up a spendthrift trust for his children. His children basically were very poor with money. And I can particularly say the daughter, if he had not created this trust for her, she would have no money right at this point in time. I mean, she would literally be broke because she spends every penny that she makes. And we even ended up having to pay the bills directly, not because there were creditors out there, but because she wouldn't even apply the payments to the correct things. What do you do to protect the assets of yourself, your spouse, or your child if they have assets of their own, if they're likely to be sued? For example, your spouse or child might be a doctor or in some other business that is prone to litigation. The answer is a self-settled trust or an asset protection trust. A self-settled trust is a trust created by an individual for his or her own benefit. It's also called an asset protection trust, and most states do not allow asset protection trusts. They don't want to encourage people to set up trusts for themselves in order to avoid creditors. But some states do allow it, and New Hampshire is one of those states. In New Hampshire, you can set up a portion of your assets into this trust. You need to retain enough assets to be able to pay your bills outside of the trust because you need to be able to support yourself. And so you can only do this with a portion of your assets. Another thing that's very important is if you know of pending litigation, you cannot establish one of these. If you establish one of these when there's pending litigation, or if you know there's going to be litigation out there, it's a fraudulent transfer and it's illegal. So you really want to think about setting one of these up in advance if you're going to do so. I liken it to being out on a ship and having a lifeboat. You know, if the ship goes down, at least you have some protection. What happens if you have minor children or grandchildren that you want to give money to and you don't want to leave it to them at your death, you want to get it to them now? There are a number of trusts and vehicles for minors that I'm going to be talking about because none of them is a perfect answer. So many people are familiar with the Uniforms Minors to Transfers Act, and that is typically a bank account where the parent sets up a bank account in the child's name, and it's managed for the child until they're 18, at which point the child has full control over it. And that is exactly the problem. The assets go to the child at the age of 18 in New Hampshire. Another option is a 2503C3 Minors Trust, and that's named for the code section that it's about. This is a trust that's set up individually for a minor. It has to be set up for only one minor, so if you have more than one child, you have to set up a separate one for each of these. And a disadvantage of this is that they must distribute at the age of 21. And that's a little bit better than the Uniform Transfers to Minors Act, but not a lot. Another option is what's called a crummy trust. And a crummy trust is an irrevocable trust where the person makes contributions for the child, and the child has the ability to withdraw those contributions when they're made, and that's the way it qualifies for the gift tax annual exclusion, so that there's no gift tax. Some disadvantages: it's irrevocable, you can't change your mind, and the child may exercise that power to withdraw. So those are a couple disadvantages. Another option is revocable or living trust. I have in my revocable trust set up for my children who are, well, one's a minor and one's now just turned an adult. And in it, I have my trust set up so if something happens to me, the trust continues until they're 25, at which point they get a third of it. They get another third at the age of 30, and the final distribution is at the age of 35. The reason I did this is I figure if they blow it the first time, at least they get another couple other chances to be able to manage these assets and not lose them. So one final thing that I'm going to talk about before I turn over the mic to Deanna is a 529 plan. A 529 plan is a tax-advantaged investment plan that encourages savings for future higher education of a designated beneficiary. The prime benefit of the 529 plan is that you pay no taxes on the earnings in the 529 plan, nor do you pay taxes when it is withdrawn, so long as it's used for higher education. And what is higher education? Well, higher education is anything beyond the high school, so whether it's college, technical school, graduate school, but it can only be used for higher education. So if you're saving for a child's private high school, it's not going to work. Everybody is eligible to take advantage of a 529 plan, and the amounts contributed can be very substantial. Most plans allow up to $350,000 to be contributed for the child over the life of the plan. Normally, you can give up to $14,000 per year on the annual gift exclusion to an individual. However, with 529 plans, there's a special provision that you can pre-fund it with 5 years worth of annual exclusions or up to $70,000. Now, don't worry about it if you don't have that much to contribute. 529 plans typically have very, very low amounts that you need to contribute to start a plan. There are no income limitations or age restrictions as well. And there's one plan in every state, and you can take advantage of any plan. So, for example, if you live in New Hampshire, your child goes to school in California, and you want to take advantage of Vanguard's plan in Utah, you can do that. So I have a client that set up a couple of these plans for her grandchildren through Bruce Stephanie at Infinex at Ledyard. And the plans are set up so that when these children reach college age, she'll withdraw and be able to help the parent contribute. The parent also contributed to the plans. You can have one plan and many, many people can contribute to that plan, but you do have to have one plan per child. Now, if the child doesn't end up going to college or using the money, you can switch the plan for other relatives. So in my example, the grandparent, if the oldest child did not use the funds or use up them, she could switch it for the other grandchild. She could also, that was with one family, she has grandchildren through her son. She could also switch it to the grandchildren and her son. She could even use it for herself if she wanted to go back to school. One unique provision of these 529 plans is even though you give the money to the child, you can get it back if you need it. So the client could take it back if she determined that she needed it. If she didn't use it for higher education, she would have to pay a 10% penalty on the earnings and pay tax on the earnings. So, and another unusual advantage of the 529 plan is even though she can reclaim the funds, when she dies, those assets are not considered part of her taxable estate. So now I'm going to turn over the mic to Deanna, who's going to talk about retirement planning and insurance and ways those can be utilized to protect your loved ones. Thank you.
Great, can everyone hear me? Sounds like you can. Thank you, Valerie. There are a number of ways retirement planning and insurance can be used to protect your loved ones. One way is to make sure that you have enough to support yourself financially in retirement. As Valerie mentioned earlier, one of the best gifts that you can give your children is to make sure that you can take care of yourself. When planning for retirement, an important consideration is, will you be able to afford the retirement that you want? Unfortunately, there's no simple answer. Much depends upon your goals in retirement, the lifestyle that you choose, and the amount of income that you can count on from your personal savings, retirement plans, and Social Security. It also depends on how long a retirement you anticipate and your assumptions regarding your future earnings and inflation. To plan for retirement, it often makes sense to have a full financial plan done. This is something that we do with our clients at Ledyard Financial Advisors. Another question is, how much retirement income will you need? Often, the desired annual income level is considered as a percent of your working income. Generally, we'll advise between 60 and 90% of your working income would be satisfactory to provide for income needs in retirement. However, if you plan to travel a great deal, you may need 100% or even more of that pre-retirement income to support the retirement lifestyle you want. Another thing to consider is inflation. Historically, inflation runs at 3%, so a given sum of money will lose half its value in 23 years. So for example, if $50,000 would support your retirement needs in the first year of retirement, after 10 years, those needs would have grown to about $67,000. And after 20 years, you'd need about $100,000 a year to support that same lifestyle. Once you've determined how much you need, how will you generate that income? One source can be from your savings and investments. I know Bruce Stephanie from Ledyard's InfluNext did a previous seminar for this group that talked about some of these plans, but quickly, some of these are SEP IRAs, simple IRAs, 401ks, and solo 401ks, as well as IRAs. What are some of the benefits of saving for retirement using these types of investment vehicles? The primary advantages are tax savings. current taxes may be reduced because when funding a retirement account with pre-tax dollars, your current levels of income are reduced, which in turn reduces your current level of income tax. Another advantage is that the assets within these plans grow tax deferred, so money is not lost to taxes during the accumulation phase. And lastly, when you retire and take funds from these accounts, you may be in a lower tax bracket, so the tax paid on the withdrawals may be less. But as a business owner, what are some of the advantages you may have as you consider your retirement planning? How would you be able to use your business potentially to develop cash flow in retirement? One strategy could be to sell the business outright and then use the proceeds to support your cash flow needs. One of my clients had a construction business. When he decided to sell that business, we worked with him to develop what we considered a dual-purpose investment strategy. We kept sufficient funds available in short-term investments to pay the capital gains tax that was due that following April. And with the rest of the balance, we developed a longer-term investment strategy to support his family cash flow needs in retirement. Another strategy could be to sell the business and then retain owner financing. While this method will not offer immediate proceeds, it could provide a cash stream of income to provide for your ongoing needs. It's important to keep in mind, though, that this strategy may not always work. I know of a case, unfortunately, when this was not successful. The owner sold the business and she offered financing to the new owner. However, due to the downturn in the economy, that business failed. The cash flow to the retiree stopped and she ended up having to go back to work. Sometimes business owners want to pass their business to family members. If this is your goal, it's important to consider how you will structure that transaction so that to develop the cash flow that you'll need in retirement. Besides investments, retirement savings, and using your business, don't forget Social Security. This is another source of retirement income. How do you determine when to file for Social Security? Generally, the amount that you receive in the first year of retirement sets the base for your future benefit payments. So as an example, let's say your full retirement age is 66, and at that point you would receive $1,000 each month in benefit payments. If you decided to retire as soon as possible at age 2 and begin to receive benefits, your monthly payment would be reduced to about $750 a month. If, on the other hand, you were able to hold off on receiving benefits until you reached age 70, the monthly payment would have increased to about $1,320 a month. So it's important to consider that when you decide when to begin to receive benefits. Many think when they're ready to file, they just go to the Social Security Department and sign up. But when the time comes, there may be strategies that you could explore to consider to maximize your lifetime benefits. The strategies are specific to each individual, and this is something that we help our clients with. After you've determined what will be available to you in retirement, a question to ask is, when you do retire, will you run out of money? If you take out too much, you might run out of funds in later years. If you don't take out enough, you may not enjoy your retirement as much as you could. So how do you determine what the right amount is? There are a number of strategies. Some folks will use a straightforward strategy of just spending income only. This could have disadvantages, though, because while you continue to take income, the portfolios would grow and you're not taking advantage of any of the capital gains that are ongoing. This may be desirable if you want to leave money to family members, but you may not get to enjoy your retirement as much as you would be able to. Others recommend that an annual distribution of between 3 and 5% is sustainable. So if you consider an annual amount of 4%, your pre-retirement goal would be to obtain and develop 25 times that amount to be able to support that type of withdrawal. This planning is something to discuss with your financial advisor, as again, it is very specific to each individual. So taking care of your retirement needs by determining your sources of income and how much you need will protect your financial future. Once that's taken care of, though, many want to consider how they can help their family members. If they can afford it, many people like to give money to their adult children. Typically, though, money given to children doesn't end up in retirement accounts. I have a client, though, who's found a way to encourage his children to save for retirement. What he's done is he's set up Roths at Ledyard, and he's offered to give his children up to $5,500 each year, as long as they've had that level of income, as long as they take that money and deposit it to these Roth IRAs. Another way to protect loved ones is to make sure to review your retirement plan beneficiary designation forms on an ongoing basis. I know of a case in which a woman had been with her current partner for about 10 years. She knew he had been married and divorced before, but after 10 years, she really didn't think too much about it. When he died, she realized that he did have a retirement plan in place, but you can imagine her surprise when she learned that it still named that ex-wife as the beneficiary. Yeah, whoops. Absolutely. So we've talked about things to consider when planning for retirement.
Ex-wife.
Wasn't pleasant. And another important topic to consider is insurance. There are many ways insurance can be used to protect your family. This morning, I will talk specifically about life and then disability insurance. How to determine if you need life insurance? Some things to consider. Do you have someone dependent upon you? A spouse, for example. How would they support themselves if something were to happen to you? Or what happens if you have a mortgage and the primary income earner dies? How would you pay that off? Do you have young children? How would they be supported? Or do you have family members that are disabled or have special needs that you are supporting? If your goal is to protect your family, all of these are good reasons to consider having life insurance. Another reason for life insurance is that it's great for asset building. Leaving a life insurance policy to beneficiaries is a great way to build assets, and it's not taxable to them as income. One of my friends lost her first husband when she was 31. They had a 2-year-old and a 2-month-old, a house and a mortgage. Essentially, when her husband died, she lost half her family income. Being young, they hadn't given much consideration to life insurance. They did have insurance on their mortgage, and he had a small policy through his employer. My friend was okay, but she tells me if they had done better planning and considered the impact of years of lost earnings, she would have considered having more life insurance. And as business owners, there are some specific considerations when it comes to life insurance. What would happen in the event of an unexpected loss of any of the key people in your businesses? How much revenue or income could you lose in the time it would take to replace them? If these issues would impact your business, you may want to consider a certain type of life insurance policy, key person insurance. This is life insurance designed to cover the prime employees of a business. It's usually term insurance, so it's in place while the person is an employee. The business pays the premiums and then receives the proceeds in the event that the employee dies unexpectedly. The proceeds can then be used to cover the day-to-day expenses as you're looking for a replacement. Another question is, if you have business partners, what would you do if one co-owner died? How will the business survive? If a partner dies, the surviving partner can be left with uncertainty. They may find themselves in business with the deceased partner's family, who may have different goals for the company. Or what if the partner's spouse and children need to sell the business to support their own cash flow needs? Will there be cash available so that they can be paid? Cross-purchase buy-sell agreements are designed to work towards eliminating these problems. These are legal contracts which protect the interests of the company's owner. Each business partner individually agrees to purchase the interests of a partner if a triggering event, such as a death, occurs. The agreement outlines specific terms of the sale. Most are funded with life insurance policies purchased on each partner with the other partners as beneficiaries. If a covered business owner dies, a life insurance policy can guarantee that there are funds available to pay surviving family members and fulfill the terms of the agreement. These agreements provide some security to both the family members and to the partners. They assure the family members that they will have funds to live on, and they assure the surviving business owners that their business would have the potential to continue. I know of a case in which a business owner arranged a cross-purchase agreement with his partners a few months before he died. When he died in his 50s unexpectedly, the life insurance proceeds were available so the partner could pay the surviving business owner's spouse for the business. So after planning for life insurance needs, something else to consider is what would happen if you were in an accident and unable to work? And what would happen if you became ill and unable to work? How would you have cash flow to cover your expenses? Most people focus on life insurance. However, during your working years, you are more likely to become disabled than you are to die. Disability insurance, insurance that pays out to you if you are unable to work, is often overlooked. Some statistics I've come upon are surprising. 1/3 of people aged 30 to 65 will be forced out of work for 3 months or more during their working years. A 20-year-old has a 3 in 10% chance of becoming disabled before reaching retirement age. One important type of insurance everyone should consider carrying is disability insurance. Someone I used to work with was diagnosed with cancer in his 30s. He was divorced and had a young son. Because he had disability insurance, he was able to take time away from work and focus on getting well instead of worrying about financial concerns. Many companies offer disability insurance to their employees. As a business owner, though, it's important that you take this into consideration on your own. If family members are dependent upon you and your earnings, disability insurance is something to make sure that you consider to pay your ongoing expenses and bills. So now I will turn our discussion over to Rob Gallo, who will talk with us about fraud and credit.
Good morning. Maintaining good credit is a vital part of your overall financial health, and leveraging that credit carefully and effectively is vital for your protection and the protection of your heirs. And today I'm going to be focusing primarily on your personal credit, And I would encourage you to have a chat with our own Jeff Johnson for matters regarding the business credit. When I started in banking in the 1980s, it was considered very prestigious to have a gold card and have tons of credit available to you. Of course, if you had a gold card, your next door neighbor wanted a platinum card. It was one-upsmanship. But times have changed significantly, and nobody needs or wants that kind of credit risk or exposure anymore. These open-ended lines of credit put you at a greater risk of personal failure when it comes to having too much exposure, but it also would subject you to fraudsters being able to get access to those untapped funds. It's also important to remember that any unpaid debt becomes the responsibility of your estate. So maintaining a select few quality products like credit cards, equities, asset-secured lines allows you the flexibility and access to credit that you need while ensuring that you have responsible, safe, and healthy profiles that protect your loved ones down the road. Now, we're hearing more and more about people who have large home equity lines and mortgages that were taken out a few years ago. Well, they're finding that their home is not worth what it was a few years ago, and this is what's called underwater. So knowing what you have and knowing what you can reasonably afford to repay is important to maintaining a healthy and financial picture and cash flow. And it's also important to note that the more credit that you have available to you, but that you don't use, runs the risk of likelihood that you'll be able to obtain future credit from other sources. So for example, if you have a $10,000 MasterCard and a $5,000 Macy's card, your potential exposure there is $15,000. That sounds all well and good, but if you all of a sudden find that you need to buy a car or some major purchase, you are at greater risk of not being able to get that credit because you have all of these untapped funds available to you. This is also important to determine your credit score, how much you have out there but is not used versus what you do have used. Having no credit can be a concern as well. To be sure, it takes a while to establish a good credit history, and your score takes a while to go up, but it can go down very, very quickly. And to a lender, having a score of any kind is the basis for any kind of credit relationship. You're encouraged as well to review how your accounts are titled or held. Being a joint owner or a co-borrower is quite different from being an authorized user. In recent discussions with people about their credit, we have seen the pros and cons of each type of relationship. We have a woman whose husband recently passed away. Now, she was listed as an authorized user on the accounts that were held in his name. Upon his death, she found it very difficult to be able to get credit in her own name because as an authorized user on his accounts, she wasn't building the credit herself. Now, the caveat to that is we also had a woman recently who was a co-borrower with her husband. When he passed away, she found out that he had amassed large amounts of debt. She didn't know about it, but was still responsible because she was a co-borrower. If you are a guarantor or personally responsible for any credit on your business, then there's further considerations that you might want to discuss with your advisor or an accountant. Oftentimes in banking, we will see when young people are just starting out, trying to establish themselves. Backtrack. Oftentimes in banking, we will see young couples that are just starting out. Previously, years ago, we would always hear the women say, "Oh, my husband takes care of all of the financial stuff." More and more now, the women are the drivers when it comes to the credit part of it. Especially on first-time mortgages, the young woman is considered the primary borrower because women tend to establish credit earlier than men do with department store cards, online credit cards, etc. Young men don't usually apply for credit until they are buying that first car or that house. As a matter of fact, we have a situation right now where there's a gentleman in his mid to late 30s who has applied for a mortgage and he has never had credit in his own name in the past. So from a lending perspective, that's a pretty good risk because we don't know. He has no history. We don't know of his ability to repay. We don't know if he's going to repay. And he might not also get the best rates of it because he has no credit behind him. So getting an early start can save you a lot of heartache later. And I would encourage you to have a conversation with your children, your grandchildren, if any of you have grandchildren. There are several simple ways to establish credit for a first-time borrower. And many banks offer secured loans and credit cards, unsecured credit cards with a lower limit, and credit builder programs. Retail store cards, when used wisely, are another efficient method of establishing credit. So now that you have your credit established, consolidating debt, reviewing your interest rates, and monitoring your credit are three of the most basic elements to protecting yourselves and your loved ones. Recently, I had a client that called me because he had gotten a letter about a past due loan for a property that he owned in Arizona. Now, not only did he not own that property in Arizona, he'd never been to Arizona. What had happened was he had a mismatch on his name on somebody else's credit report. That was a pretty easy fix, but if he had been a victim of a fraudster, this could have been a much more serious consideration. That being said, you are encouraged to review your credit report on an annual basis. We recommend annualcreditreport.com. This is a government-mandated site, and it's available for you to review your credit and your scores from all three of the major repositories, Experian, TransUnion, and Equifax. The site is secure, and it provides one free credit report annually. It doesn't give you your credit score number, though. That you have to pay for. It's $7.95. But it has been reported to lenders that the scores available through this site are what lenders will use to determine your score, and it's more reputable than some of the ones that you've probably seen on TV for sites offering free credit reports. These sites typically require you to enroll in something for an ongoing credit monitoring program for a fee. I encourage you to exercise caution when using these. Once you get signed up, it's kind of hard to get out of them, almost like a health club. So this is your credit we're talking about. Now, another industry that has popped up recently revolves around identity theft protection. Like the various free credit report companies, most of these identity theft companies will offer you a fee-based variety of services, from fraud alerts and junk mail reduction to credit report access and ID theft restoration. Ledyard offers a free identity theft package through our Generations Gold program, and I'd be happy to talk to you about it afterwards. There are, of course, several reputable ID theft companies out there for you to work with, but I would encourage you to shop wisely, because there are a lot of not so good sites out there, and there's not a lot of good identity theft protection available to you. So if this is an avenue that you wish to pursue, be careful with it, because it's your identity that we're talking about here. And so why is this something that you might want to pursue? Well, consider this. According to the governmental and independent studies, there is a new identity theft victim in the United States every 3 seconds. Last year, there were 13 million reports of identity theft, with losses totaling more than $20 billion. And in fact, the IRS reports that 3.6 billion, billion with a B, in fraudulent tax returns were filed in 2011 alone. Now, these were not $1 million tax returns. These were numerous, $12,000, $15,000, $18,000 tax returns that totaled $3.6 billion in fraudulent claims. Now, you may have also heard about granny scams. Unfortunately, these are becoming more and more common. And recently, a local woman was contacted by her grandson indicating that he was coming home from school to surprise his mother for her birthday, but he had a traffic incident in New York and was arrested. Well, the woman wanted to wire funds right away to him because he was in jail, and said, "But please don't tell Mom." So after several questions and concerns that we raised with the woman, she was absolutely convinced that it was her grandson that had called her. She insisted that the money be sent. Well, I don't have to tell you, do I? She got scammed out of several $1,000s. How would you guess that the perpetrator knew so much about her grandson that he was able to convince her that he was in real trouble. You got it. He got all he needed from some posts on a well-known social networking site, we'll call it. She proudly boasted in one that her grandson was the third generation in her family to go to XYZ University. And in another post, she was bragging about how little Jimmy is coming home to surprise my daughter Sue for her 50th birthday. Those two innocent posts was all that a fraudster needed to get thousands of dollars out of this woman. Now, I'm not going to go into great detail about all the other scams. I'm sure you get fraud alerts and scam alerts frequently, and you sort of keep up with it on Google. But if anyone contacts you about buying or renting something that you have posted on a site like Craigslist or whatever, and offers to send you more than you're asking for if you wire it back, don't do it. And I assure you, you have not won a lottery or a sweepstakes. You have not been pre-approved for an I've fallen and I can't get up system, or anything else that you'll need to provide your bank account or social security number in order to receive. So while credit reporting and identity theft agencies are all excellent preventative resources, your best resource is you. If you have any questions about anything that is questionable, if you have a fear about something, if you receive an email that you're not sure is real from a bank, get in touch with your banker. They'll walk you through it. That's what we are here for, is to protect you and your loved ones going forward.
We don't have a lot of time, but are there any questions? Yes?
I don't have a question, but I have one follow-up that I want to bring to people's attention from something Rob was talking about, joint accounts and authorized users. A case, it was a criminal case, just came out about a week ago that actually has fairly far-reaching implications for all of this discussion. The case involved, I don't know, we'll call her a helper with an old lady who had some trusts and had some annuities, and the helper convinced the old lady to cash out on these annuities and get big checks and deposit it into a bank. And then the helper said, well, why don't we create a joint bank account and I'll pay your bills for you so you don't have to worry about these things. Well, you know exactly what happened. Out went the money. The case was very interesting because how can you convict somebody of stealing money when they're on a joint bank account? Husbands and wives are on joint bank accounts, business partners are on joint bank accounts. The Supreme Court said, yes, you are convicted of unauthorized taking in this particular case. That was a criminal incident. That being said, if you think about husbands and wives, maybe divorcing, business partners, or any other type of situation where you're on a joint bank account or your partner is on a joint bank account with you, and suddenly money just goes. It's important to remember that just being on a joint bank account and being an authorized user doesn't necessarily limit your liability, particularly criminal liability. And I would venture to guess civil liability down the road hasn't been brought there yet. But it's important to remember that just because you share, it doesn't mean you have quite the rights that you might think you do. And we've all heard of divorce cases where, husband and wife are getting divorced and they had a joint bank account, and one of them shows up to the bank and all of a sudden it's all gone, and well, what can I do? Because they had access to that money too. And that's just worth keeping in mind.
Thank you.
That's all.
There was another question over here.
Yes. One is, I'd like to say thank you to Ledger, because the other day I received a phone call asking if I really did want money wired to an antique store in China. $41,000 or something like that. So the system did work within Ledger, which I'm very appreciative for. And also, within all of your estate planning and things like that, how active is charitable donations and thinking about using estate planning
Yeah, there are a number of vehicles that can do that, and it's a lot of material, so it would be a good topic for another seminar. But I'd be happy to talk to you individually. Then I saw one more question, and then we probably ought to go. Daphne?
Well, mine was also just a comment that, in my experience, well, it was great to hear from Rob, because I actually have clients who are always asking about how to protect themselves from fraud. So generally, I go back to the U standards, so I'm glad you left it like that, because I thought, am I missing a major protection? I wish we had more to offer really our older clients who are feeling very vulnerable about that. The other thing I would say is these days with trusts, you know, people come and say, well, I'm not, you know, I don't have over 10 million plus of wealth or 5 million for an individual of wealth, so I don't really need a trust. But you know, just talking about probate avoidance and you know, just people do need wills, but people often want to know, what does a will do? What does a trust do? So that gets a little confusing, but we're still talking about that and probate avoidance, and also being, you know, having the utmost control, I think, in terms of a trust vehicle and how nimble revocable trusts can really be for your lifetime planning. So
Thank you.
This was all great.
It's 9 o'clock, so I'm gonna let Kathy draw, but if you do have more questions, we're gonna be here afterwards, so I encourage you to come over and ask them. We'd be delighted to help you. Thank you.
Thank you to